This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker here with Manus Clancy, and welcome to this week's episode. So let's dive in with the news developments this week. Manus, late last week we got inflation numbers. CPI came in pretty benign. PPI actually ran cooler than expected. Retail sales came in below expectations. Yet, bond yields went up. The 10-year was sitting at 4.71. Just this morning, it went down to 4.62. The 30-year broke 5.31% this week, and that was the highest print in 19 years. In the equities market, NASDAQ and S&P hit all-time highs, so it's like the stock market's partying like none of this matters. In the housing market, investors say that this is the worst market that they've seen in 3 years. We have to talk about oil. Oil is above $90 per barrel as Iran signals an escalation in the conflict. And the last thing I wanted to open with was on the soft data front. There's new survey data from Berkadia pointing to 61% of investors who are holding a negative view of multifamily over the near term, likely a reflection of higher rates, higher operating costs that are pressuring NOI. So Manus, I ask you, should we be worried?
It was a very paradoxical week for me, at least. On the one hand, you see the kind of prints that you would think would naturally push interest rates lower. You mentioned the benign CPI report. You mentioned PPI coming in sharply lower than expected. We saw a jobs number 2 weeks ago that was really anemic. We saw negative job growth. And those are the kind of things that the first reaction of the market is to push bond yields lower, to make the conclusion that inflation is not as bad as we thought. The U.S. economy is not overheating. We saw retail sales late last week, which were disappointing. All of that points to taking pressure off the Fed to raise rates. And normally, these types of conditions result in bond yields falling. And what we saw was the complete opposite. We saw the yield on the 10-year jump to as high as 4.75. We saw, as you mentioned, the yield on the 30-year hit a 19-year high. The 30-year, not all that important for the CRE markets, but the 10-year certainly is. And it was paradoxical for me. You would have thought that these numbers would have pushed bond yields lower. To me, it's a reflection that people are coming to terms with, first, that the war in Iran is not anywhere close to being done, that we will be forced to live with $90 a barrel oil for the foreseeable future, and the next move in prices may be higher. That's what the bond market is telling us. Now, we had some really important news come out this morning. We were recording on Wednesday morning, and it was revealed that Treasury Secretary Bessent is going to support steps that will result in buybacks of long-dated treasuries. The yield on the 10-year this morning is falling and falling sharply. That is helpful. But by and large, I think that the market is on tenterhooks right now because of higher rates, higher oil, and no end to the war in the immediate future.
Yeah, I mean, you're not wrong. I think the cooler inflation data last week, as you said, it would have been the story that the bond market would love and that you would have expected that yields came down. But I think it's clear the bond market's not pricing the data. It's pricing the risks that are around the data, like the geopolitical risk premium deficit. And the market's repricing, I think, for a world where rates stay elevated for longer, where oil prices aren't going to come down anytime soon. And, if you're a lender, you're thinking, I better be disciplined in my underwriting because I can no longer assume that I'm going to see rate relief or inflation come down or the things that you would expect might bail out aggressive underwriting. And as usual, Manus, you're one step ahead of me because I had not seen that news this morning about Bessent, but I think it's recognition that higher yields aren't good for anybody. So they're going to take a policy position to try to get those down. And we're already seeing the needle move, as you said, down to 4.6 from 4.7.
And let's not forget that this is an election year. The midterm elections are coming up. And I think steps like this will be taken periodically between now and November. The president has never been shy about trying to change the narrative. Peace is at hand. A deal is close. the war will be ended. The war will be ending on our terms. I think what you're seeing right now with the Treasury moves is maybe it's panic or maybe it's concern. Maybe this would have happened if we weren't facing an election. But the reaction tells me that the people sitting at Treasury right now are worried that 475 on the 10-year is a big threat to economic velocity and perhaps the election results in November.
Mm-hmm. Absolutely. And then what was your take on the soft data front, that survey from Berkadia on multifamily?
I think it's a real inflection point. I do think we've been through, what was it, Dante's 10 levels of hell or 12 levels of hell, right? In the Inferno. We are marching through different levels of investor reactions to what we're seeing geopolitically and in the U.S. economy. I think we started in a heavenly position, you might say, at the beginning of the year. Interest rates were low, oil prices were low, enthusiasm was high, and people were thinking 2026 was going to be a very, very good year for refinancing, for transaction velocity. I think people got nervous in the spring, but the market soldiered on. So maybe we were one level below heavenly. We were in that first level of Dante's hell, right? Which said we have uncertainty, but we're still going to keep going on and transacting business. I do think now that the war has continued, now that we're starting to see the reemergence of higher oil prices, I think we've moved into level 2. And level 2 is, it's time to get a little bit worried. The heat is picking up here. And I think that Berkadia survey shows that. We've gone from we're all in January in our forecast for refinancing and sales activity to 2/3 of us being quite nervous right now. And I think that that is an important inflection point, as is our LightBox Activity Index, which kind of underscored that as well this month.
Right. Very true. With its second consecutive dip in the index. So we'll have to see what happens in August and whether it continues that trend for the third month. And the fact that the Berkadia survey was specifically in multifamily, which has been, no matter what metric we look at in the LightBox ecosystem, it's where we've seen the majority of listings. It's where we've seen the majority of potential interest in terms of the average number of non-disclosure agreements filed per listing. It's dominated the transaction data that your team collects. So seeing investors in that segment tap the brakes a little, and acknowledge that they see more caution because of what's happening in capital markets. And, maybe that translates into, if not an outright slowdown in multifamily investment, maybe a pivot as they rotate away from things like value add and opportunistic plays and maybe more toward safer core plus strategies in multifamily. They did quote one guy that I want to mention here, Josh Bowden. He's a senior VP of capital markets and strategy and trading. And he said investors are bullish on multifamily still. They're just cautious on individual deals right now. So definitely worth noting.
We know what happens during these times, that the bid-ask spread widens, that sellers think that we're still dealing with lower interest rates and they try to hold the line on what they're asking for in their price. And we also know that buyers read the tea leaves differently. They know that their cost of funding is going up and they want to see a discount compared to what they might have paid in January. And when that dichotomy appears, what you see is that widening of the bid ask, and you see a slowdown of transactions. People take longer to meet in the middle and come face to face with a new reality. I do want to pivot to one other thing before we end, and that is we talk about the glass half empty and the glass half full. And, it could be Christmas morning and two twins could wake up and each can get a sack of coal. And one twin will say, "Oh my God, my parents really are thinking I'm a bad person." And the other twin will say, "Have you seen coal prices this morning? We're rich," right? It's all in how people see things. And what we have right now, in my opinion, is one twin is the bond market and one twin is the equity market. On the one hand, that sack of coal has come in higher rates and pearl clutching and fear that the next move is going to be higher interest rates. Bond investors are nervous and cautious. And on the other side, with all these benign and cooler than expected economic prints, the equity markets are applauding. They're saying the Fed is going to cut. We're going to see more favorable conditions in the future. Euphoria goes on steroids. And that's what we were seeing last week with the NASDAQ and the S&P 500 hitting new all-time highs yet again. This week, it's been a little bumpier. I think the equity markets are coming to grips with the fact that maybe their twin is right and they are wrong, and the equity markets are lower this week. It's really a tale of two different markets right now.
Yeah. And I think paradoxical is the term of the week for sure. I love the analogy of the bags of coal and the Clancy twins on Christmas morning.
Well, I would say both of my twins, I have twin girls, that they are both pretty glass half full and live life to its fullest, I would say. So I was talking about twins in the theoretical sense, not my own. Not that I think my twins would ever listen to this podcast. They'd be out listening to Taylor Swift.
But it doesn't sound like the apple fell too far from the tree in terms of the glass half full. I will jump to one more thing, Manus, before we move on. And we have to talk about data centers this week. Very different from what we just talked about in terms of multifamily and some caution really entering. I mean, data centers seem like the segment that just will not slow down. And one headline that caught my eye this week was Bank of America announcing plans to inject $250 billion into an infrastructure initiative to boost U.S. investments in data centers, in energy, in minerals. And they're not alone. Morgan Stanley has a similar $1.5 trillion initiative to invest in AI, and JP Morgan Chase has a $1.5 trillion initiative, which includes financing for energy, data centers, and so on. So, the bigger story is that despite everything else that we've just talked about, there's this Wall Street-wide capital deployment theme that just keeps getting wider and wider, with B of A as the latest player jumping in.
I did see the headline, and thank you for pointing that out. I didn't get into the weeds on that about specifically how this money will be deployed. They talk about data centers and energy and so forth. That can hone in on a very narrow segment, like data centers alone, or it could be a very broad segment when you talk about the energy suppliers to data centers, the GEs of the world, and the others that are building technology to cool these plants and power these plants, the nuclear micro power plant generators, things like that. For me personally, as an investor, I would feel much more comfortable in a fund where the portfolio manager is spreading their bets. I do think that this data center euphoria, this madness that we're seeing, could end badly. People are borrowing hand over fist, using their free cash flow to buy land and develop data centers across the U.S. We have no idea what 10 months from now will look like, let alone 10 years, when it comes to data center demand. But I do know that there'll never be an end to energy consumption and the need for more and more and more in this country. So if I'm a portfolio manager, I feel much more confident if I'm buying not just data center investments, but the suppliers, the power suppliers, the pipeline suppliers, the infrastructure builders, the chip makers, and other things that are not directly tied to data centers.
Mm-hmm. Yep, very true. And I'll add just one more thing is I spent some time last week in Eastern Pennsylvania, and it was the first time that I had been in an area of the country that was a target of data center distribution. So it wasn't uncommon to see signs in store windows that had data centers with a big slash through it, signs by the side of the road that said you can't drink data. It was the first time I kind of saw that community pushback face to face. And tech firms are starting to really take that seriously by having more proactive town meetings and running campaigns to convince locals that there are benefits to having data centers in their area, which they weren't doing 2-3 years ago. So that kind of NIMBYism, I think, might also redefine where data center investment is starting to happen in terms of geographies. So a lot happening on that front.
It's funny, my family kind of lived through this in a different form 40 years ago, in that we lived adjacent to a nuclear power plant that was under construction. And if you remember, some of our listeners will remember, but most will not because it was a really long time ago, there was enormous pushback against nuclear power. You saw musicians like Jackson Browne and James Taylor and Bruce Springsteen come out, have concerts against it. People would show up at the nuclear power plants and hold protests and so forth. And to some extent, it worked. The one on Long Island that they were building up in a place called Shoreham was shut down, and the results were not great. Energy prices soared on Long Island. They were among the highest in the nation. And we look back 40 years from now and we say, wow, nuclear power really was safe, and it would have benefited people around Long Island immensely, especially at the lower end of the economic curve. Lower energy would have been the answer there. And I have no crystal ball here on data centers. Maybe they will be miserable for the constituents of Eastern Pennsylvania for the next 40 years. They will drive up energy prices. But it just goes to show that you just don't always know that, your immediate reaction to certain things may not be how it plays out over the course of 20 or 30 years. So we'll have to see.
Yeah. Very wise historical perspective and of how perceptions can change over time. But right now, the anti-data center sentiment at the local level is very high in some of these areas, as I saw firsthand last week.
As the capitalist that I was, even at age 16, I would run down to the local beverage center, buy 20 or 30 cases of CNC Cola for 12 cents a can, and then show up at the protests and try to sell them for $1 a can.
Fabulous.
In the blistering heat on Long Island Sound in the summers of my youth. It's time, Dianne, for our weekly data dive as we pivot away from the news of the week into what you're seeing at the ground level.
Yeah, thanks, Manus. So I spent some time looking into July's transactions data from your team. And one thing I was interested in was where we were seeing the most significant increases in terms of property type. So comparing Q2 to Q1, industrial properties as well as retail showed the highest percentage jumps quarter on quarter. And I also looked into retail hotspots, and I'll give you the 4 hotspots nationally for retail deals. New York City saw the highest number of deals, including Brooklyn at 23. Annapolis came in second, but that was really because of one big $26 million mall deal. Miami came in at third with 4 big retail deals, and Chicago was right behind Miami. So that's where investors in retail are really focusing right now: New York, Miami, and Chicago, with Annapolis as a bit of an outlier.
Right. That Annapolis mall sold for a big price a couple months ago, and in a small market that could really move the needle. I do think that we're talking about 2 really different things when we talk about retail and industrial. I think in the industrial side, there's just this insatiable appetite for people to buy these assets. Just this week, we saw another EQT sale where they bought another $1 billion portfolio a couple days ago. It never ends. So it's strength building upon strength in the industrial segment. I think in the retail segment, it's more rebound. Retail was probably second only to hotel in terms of trailing the market in terms of velocity. Industrial, of course, very big. Multifamily, always very sizable in terms of economic velocity, even when markets are down. The office segment, we've talked about this quite a bit. We're seeing a lot of transactions there. I think we've seen in the last 6 months a nice uptick in retail, that market has started to see a rebound from what was kind of a tepid activity level in 2025.
Mm-hmm. For sure. And consumer spending has been very strong. Construction has been very low in retail, so vacancies are very low as well. A lot of people wrote off retail a few years ago, but I think it's really been a surprise on the upside for investors.
I'll take a quick detour. We did talk about retail sales last month being disappointing. There was a subheadline to that which said a lot of that disappointment came from the fact that so many Europeans had left and South Americans had left. They had come here for the World Cup and were spending money on jerseys and other items related to the World Cup. So, Dianne, I have to ask you, was there a World Cup jersey in your family's home over the last month? Were you out there at Dick's Sporting Goods buying the Messi or Ronaldo jersey for one of your children or your husband, or were you sitting it out?
We did not. We were very excited to watch it, but we didn't go for any of the merch. I will say there was a lot of anti-Messi sentiment in the house, so it seemed like everybody was rooting against him more than for any one individual team. But I miss the World Cup hype. That was really a fun summer chapter this year.
I don't get the Messi antipathy that people have. It's out there for sure. I see him on all these commercials for Michelob Light and Lowe's. He's always smiling. He seems like a happy guy.
Sure.
On the field. He seems like happy-go-lucky. So I'm a real tourist when it comes to soccer. I watch it during the World Cup and I enjoy it. but I don't know the ins and outs. But Messi to me seems like a likable fella.
Mm-hmm. Yeah, he definitely rubbed a lot of people the wrong way. I didn't really have an opinion on him because I was just kind of an oblivious bystander. But I loved all the hype and the pride, and it's the same kind of feeling that you get when you watch the Olympics. And I did think you talked about their spending. I found it hilarious that they couldn't get enough of ranch dressing and were grabbing that to put in their luggage and take back to their countries and hoping TSA didn't snag it in security.
Maybe we should go along one of these ranch dressing makers. I'm not sure which conglomerate makes the most ranch dressing, but maybe there'll be a surprise for the upside next time they announce earnings.
Maybe.
I'm more of a honey mustard dressing kind of guy, but I'll take ranch if it's the only thing available.
Like a good American.
There we go. Now, Dianne, it's time to move into our next segment, the Did You Know? Let's hear it.
I don't really have a specific data point, but I wanted to take a minute here, Manus, to talk about our LightBox Live platform. You know, I'm a real data junkie. I know you are too, but I finally had some time to really play around in that platform. And I have to say, even though it'll sound very self-serving for LightBox, but it's a really cool aggregation of a very wide universe of data. So, you know, I went right where I live and I clicked on the market view and played around with an MSA. I just arbitrarily picked Phoenix. And right there with like a couple clicks of the mouse, I see all the sales that were there in the past 7 days, intelligence on the buyer, the seller, the comps for each one. Click on another button, I see 11 listings in the Phoenix MSA this month by asset class and details on each, the last sale price, and then even a news tab where I could see analyst reports on the local market. And, you know, I just wrote a white paper for CRE Network, which is a great association of women in commercial real estate because their convention is coming up next month. And it was a white paper on technology trends, you know, and it's just amazing when you talked about historical perspective in terms of nuclear power plants, but like the historical perspective when you think about technology and what's changed in commercial real estate. As I look at LightBox Live, like what it would have taken years ago to compile all of this data. And now I can just sit here with a few clicks of the mouse and get a really good handle on one market, you know, what's coming onto the market, what's sold, what are analysts saying about it. I mean, it's really, really impressive and a tremendous time savings. You're on mute, Manus.
As the boomer that I am, I can't resist almost in every podcast the classic rock analogy here. So I will channel Bachman Turner Overdrive. Do you remember them from back in the day? That you ain't seen nothing yet. Do you remember that song?
I do.
You ain't seen nothing yet from BTO.
Of course.
And I'll apply that to LightBox Live because as impressive as it is right now, there are things that we talk about every week. Things like appraisal velocity, due diligence velocity, where this is happening. We haven't even connected all the dots yet. And when that stuff gets connected, which is not far away, people can start to see where is all the development happening within a really narrow submarket in Phoenix. If I'm thinking about putting up a multifamily development in this particular sliver of Phoenix, am I alone in my thinking, or are others thinking the same way? Have phase ones been taking place at high levels in this narrow window within the Phoenix MSA? Or might I have this thesis to myself? Some really exciting things coming. They're not there yet, but all the stuff that we talk about here, Dianne and I, are things that can be tapped. So to help people make better decisions in the future.
Yeah, it's really, really great. All right, Manus, let's move to the sales that caught your eye this week. Where do you want to start?
So we'll start in the industrial segment. We talked about this before we started recording. The biggest one that I noted this week was a $400 million purchase, Sparrowhawk and Almanac Realty acquiring 4.4 million square feet in a Midwestern portfolio. So this is kind of Ohio, Cincinnati MSA, that Missouri-Illinois border. Sparrowhawk and Almanac paying $400 million for this particular portfolio. But I also noted a few minutes ago that we saw EQ buying a 22 property portfolio for $1 billion. So these industrial properties and portfolios continue to sell in just staggering numbers. 2 really big portfolio sales this week. On a more single property level, the biggest one we saw this week, Morgan Stanley paying almost $160 million for a 1.5 million square foot Ace Hardware distribution center in Kansas City. So we talked about it. Industrial quarter over quarter sales are up, and this week's sales showing really no sign of tapering off.
Yeah, and the Sparrowhawk deal and Morgan Stanley, those are both in Midwest logistics markets. And I have to say, the Ace Hardware reference reminded me of those old commercials. Do you remember? Ace is the place with the helpful hardware man, which seems like a pretty silly slogan by today's standards.
I think John Madden, the old football announcer, was their spokesman. He'd come on and talk about all the things you could get at the Ace Hardware. As somebody who's not terribly handy, I could barely put together a Nerf hoop. I don't see the inside of an Ace Hardware store all that often. So the further away from a tool belt that I am, probably the safer my house is, I would have to say. So I will pivot to one that I would say is industrial adjacent, one more sale that we have here. BREIT, the Blackstone REIT. It has been in the news for several years. A few years ago, they were overwhelmed with redemptions, people wanting their money back. They were forced to cap their redemptions because they didn't want to be selling things at a fire sale price when interest rates were rising. I think they still fall under redemption stress. I think people still want their money back from that REIT. But this process has been playing out now for 24 or 36 months. But the headline here is REIT is moving out of the self-storage sector. It has sold, I think, the last of its portfolio in that particular segment so that, and this is a word from the headline, from the Real Deal, as it chases the data center jackpot. So BREIT moving out of self-storage, which has been quite reliable, really since the beginning of COVID, into something that is more alpha. They're looking to capitalize on this data center mania that we're going on right now, and they're laying all their chips on the data side of the table.
Yeah, pretty major pivot on their point. I think I read that they deployed nearly $6 billion into pre-lease data center development just in the first half of 2026, and that data centers have grown now to more than a quarter of its real estate value. So, I mean, these numbers are just staggering.
Just to put a bow around the sales, by the way, I misspoke a moment ago. That EQT real estate sale, not $1 billion, $1.2 billion for those 22 industrial properties. The seller there, by the way, Rexford Industrial Realty. So a correction there.
All right, Manus, let's switch gears and move to development. What headlines caught your eye this week?
Well, this is where rubber meets the road for me. And I tell this to people at LightBox really every week, that when interest rates go up, when people pull back, when the market gets cautious, the first thing to go is those financings which require trickiness, putting shovels in the ground where there's execution risk or building conversions. And so I'm always on the hunt every week to see, are we still seeing developers getting the financing they need to build new properties or to convert existing ones? And we had a couple this week that I thought were worth noting. In Queens, Domain secured $175 million in financing for a development in that market. Queens, one of the 5 boroughs of New York City. Of course, we know the headlines that there is never enough supply of multifamily housing in New York. Rents always first or second in the country. It's either New York number 1 and San Francisco or Miami number 2, or vice versa. I think recently Miami and San Francisco have surpassed New York, but never enough supply. So seeing Domain get that number, I think very important. Elsewhere, we saw a headline in Commercial Mortgage Alert where Neftali is seeking, this is a big number, $1.3 billion to build new condos in New York. This would be at 800 Fifth Avenue. So really Upper East Side, probably the primest of prime real estate on the Upper East Side, overlooking Central Park. It'll be interesting to see how they do. That's a big number to ask. I imagine what they're looking to put up there is another billionaire tower, those kind of things where the apartments go for $25 million, probably for a studio, and up. And that always hasn't worked out well. Those billionaire towers on Central Park South, a lot of them sat vacant for a really long period of time. I don't think there were any big losses there, but we'll have to see both whether Naftali can get the money and if the development takes place and if it's successful.
Yeah, and the article said that sales of the condos haven't begun, but the aggregate sellout value would be roughly $2.9 billion, which suggests that one unit would cost around $55 million. Pretty high
Yes,
price
that's
tag.
petty cash for you, Dianne, right? So I have to ask Dianne, if and when you become a true empty nester, do you and your husband have a prime locale? What is your Shangri-La?
Interestingly, I think you'd get a different answer from him than you will from me, but I see myself on Cape Cod. I'm definitely a beach person. I love the mountains and skiing, but if I had to pick my retirement plan right now, it would put me on Cape Cod for sure.
So a couple more in the leasing development category. I'll throw these out there. They're a little bit random. They're not necessarily financing per se. The first one, Gary Barnett, he owns Extel. He was one of the real developers who put up these first 110-story multifamily projects on Central Park South, catering to the ultra wealthy, the billionaires of the world. He has been assembling a set of properties in Midtown Eastish. Most recently, he paid $65 million for 110 East 55th Street in Manhattan. This is the third or fourth property he's assembled in that area. The interesting part of this story, he nailed, even though the purchase was $65 million, he nailed a $327 million loan from JP Morgan Chase. So clearly, he has eyes on building something really spectacular with this assemblage. We already know that Citadel is working on a mega project at Park and 51st. We'll have to see what comes out of Gary Barnett's next move. Is it high-end office like we've seen at One Vanderbilt and the JP Morgan Tower? Is it more high-end multifamily like we're seeing on the Upper East Side? Time will tell, but moss doesn't grow under Extel's feet. They are always moving and buying and thinking about the next twist.
Yeah, I was thinking as I listened to you detail this story, Manus, Gary Barnett is like playing, development chess in Midtown. This isn't like a conventional office acquisition. You can almost picture the Monopoly board, him putting things down on it as he builds this space with assembling adjacent properties. He's securing air rights around Park Avenue, which could end up being a real hub of redevelopment activity.
Well, mega broker Bob Knackel once told me that assemblages are not for the faint of heart, that they take years and years to pull off. A lot of time you're spending money and it sits spent, not collecting interest, not deployable for years before you ever put a shovel in the ground. So it takes incredible patience. It is a high wire act in many ways. And yet Gary Barnett is one who has pulled it off several times. He is the Philippe Petit. You could look him up, Dianne, of commercial real estate in New York.
Philippe Petit. Isn't he the guy who walked the wire?
There you go. He walked
man on wire.
The tightrope between the two sides of the World Trade Center back in the 70s.
There was a terrific documentary on Philippe Petit. He's a very colorful person. All right, Manus, let's close with our slice of life. I want to draw attention to a story I saw in sfgate.com, and they used the term office resorts, and it was around a story about a development called 88 Spear. It's projected for completion at the end of this year, and it claims to be the country's first office resort, a new type of office building that's catering to what employees ostensibly want out of the spaces that they work in 8 hours a day. So they want this office building to not feel like an office building at all. They want it to feel like a luxury hotel. So Manus, my question for you on our slice of life is, what amenity would be the most appealing to you to get you to the office 5 days a week?
Wow, that is a great question. And my mind is racing right now. I can think of several things that I would love and several things that I would not love. The first thing I would love would be a terrace. That would be wonderful. A place to go outside, especially a shaded terrace where you could have a cocktail after work with your coworkers and overlook whatever city you were in. I would say a nice reading room where the newspapers were laid out for you, Barron's, the Wall Street Journal. You could go there and quietly detach, and a great cafeteria would be wonderful. What I don't need a masseuse, and I don't need a checkout line like at a luxury hotel where you're waiting to contest your bill.
I love it. I'm with you on the terrace one. I love being in, especially if you're in New York City, having a nice terrace to go outside and have some greenery around you and enjoy the view. I spent a little bit of time with former colleague Dan Gottlieb, who works at the Rockport Group now, and they have a really nice terrace off of Fifth Ave that's really terrific. Agree with you on the massage stations. I mean, I'm not big on things like mani-pedis, but I think at the top of my list would be a really, really good coffee bar. Office coffee isn't notoriously good. So if I had somewhere to get a non-fat flat white with an extra shot, I'd be happy. And I got to say, dogs, Manus. LightBox's New York City office has a really sweet office dog. I think it belongs to Noah Ackerman. His name's Mater, I believe, and he's a big doodle. And you could be under the most stress, have the biggest deadline hang over your head. And I see a dog and I just feel my stress level come down. So if there could be an area where you could just sit with dogs, take them for a little walk around the block, I would love that.
I would love that too. I think that would be great. And one of the more underrated things, this doesn't really apply to women's shoes as much as men's, the shoe shine. The guy who comes to your office, and it's not so much about making your shoes look good. It's more like a massage for your feet in your office. And so if a shoe shine guy could be part of the budget, I would throw that in as well. So there you have it.
Very old school. Love it. Dogs, coffee, shoe shine, news library. That's a pretty good list we came up with.
There we go.
All right. Well, that seems like a good place to wrap up. Thank you to our producers at Bruning Media. Be sure to join us next week as we drill down into the news headlines, deals, and developments of the week. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.